is a venture capital investor in Santa Fe, New Mexico. Mr. Loy is testifying on behalf of the National Venture Capital Association, which represents the U.S. venture capital industry and is comprised of more than 450 member firms. Welcome.
Thank you, Chairwoman Velasquez, Ranking Member Graves, and members of the committee. Thank you for the opportunity to be part of this important discussion today. I'd like to begin by talking about risk and the difference between entrepreneurial risk and systemic financial risk. Entrepreneurial risk involves making calculated and informed bets on people and innovation and is critical to building small businesses. Systemic financial risk involves a series of complex financial interdependencies between parties and counterparties operating in the public markets. The venture industry and the small business community are heavily dependent on embracing entrepreneurial risk, but we have virtually no involvement in systemic risk. And let me explain why. The venture capital industry is simple. We invest in privately held small businesses created and run by entrepreneurs. These entrepreneurs grow the business using their own personal funds, as well as the capital from ourselves and our outside investors, known as LPs or limited partners. We invest cash in these small businesses to purchase equity, i.e. stock, and we then work closely alongside the entrepreneurs on a weekly basis for 5 to 10 years until the company is sold or goes public. When the company has grown enough so that it can be sold or taken public, the VC exits our investment in the company and the proceeds are distributed back to the investors in our funds. When we are not successful, we lose the money we invested, but that loss does not extend to anyone else beyond our investors. Even when we lose money on investments, it doesn't happen suddenly or unexpectedly. It takes us several years to lose money, and the investors in our funds all understand that time frame and the risk when they sign up. Debt, known as leverage, which contributed to the financial meltdown, is not part of our equation. We work simply with cash and with equity. We do not use debt to make investments or to increase the capacity of a fund. Without debt or derivatives or securitization or swaps or other complex financial instruments, we don't expose any party to losses in excess of their committed capital. In our world, the total potential loss from $1 million investment is limited to $1 million. There is no multiplier effect because there are no side bets, unmonitored securities, or derivatives traded based on our transactions. There are no counterparties tied to our investments. Nor are venture firms interdependent with the world financial system. We do not trade in the public markets, and our investors cannot withdraw capital during the 10-year life of a fund, nor can they publicly trade their partnership interest in the fund. The venture capital industry is also much smaller than most people realize. In 2008, U.S. venture capital funds held approximately $200 billion in aggregate assets and invested just $28 billion into startup companies. That is less than 0.2% of the U.S. gross domestic product. Yet over 40 years, this model has been a tremendous force in U.S. economic growth, building industries like biotech, semiconductor, and software. Now we're increasingly helping to build renewable energy and other green tech sectors. Companies that were started with venture capital since 1970 today account for 12.1 million jobs and $2.9 trillion in revenues in the U.S. That's nearly 21% of the U.S. GDP, but it grew from our investments of less than 0.2% of GDP. My main point, therefore, is that harming our industry will prevent a major part of the future American economy from growing out of businesses that are today's small businesses. And that is the risk that you should be concerned about. Now, we do recognize the legitimate need for transparency, and we simply ask that you customize the regulatory approach to fit what we do. Today, VCs already provide information to the SEC. That information submitted on what's called a Form D should already be sufficient to determine the lack of systemic risk from venture capital firms. This filing process could easily be enhanced to include information that would provide greater comfort to our regulators. An enhanced Form D, let's call it Form D2, could answer questions on our use of leverage, trading positions, and counterparty obligations, allowing regulators to then exempt from additional regulatory burdens firms like ours that don't engage in those activities and therefore don't pose systemic risk. In contrast, formally registering as investment advisors under the current Act, as the current proposals require, has significant burdens without any additional benefits. And let me be clear, registering as an advisor with the SEC is far from simple, and it's not just filling out a form. The word registration in that context might sound like just registering your vehicle, telling the motor vehicle department what kind of car it is and who you are and where you live. It might even conjure up images of things like smog checks. And our proposal for the Form D2 is sort of equivalent to that. But actually, the word registration in an SEC context comes with a lot of other set of requirements. To continue my analogy with your car, it's equivalent to having to hire a full-time driver plus a compliance officer who rides in the front seat to make sure that that driver is operating the car correctly, plus a mechanic who lives at your house to fix the car and works only on your car, plus providing the government with information about every place you drive. Moving back to the actual world of SEC registration, involving examinations, complex programs overseen by a mandatory compliance officer, it will demand significant resources which promise to be costly from both a financial and a human resources perspective. My own firm believes it will be about 1/3 of our entire annual budget. Your support has not gone unnoticed by us, and we very much appreciate it. And as you can understand, we cannot afford another situation where the unintended consequences of well-intentioned regulation harm small businesses and the economic growth that we drive. We look forward to working with the committee on that.